Today, I'm going to walk you through the absolute best place for you to invest in a short-term rental in 2026. AirDNA just came out with their best places to invest list, which is something they do every year. And this list has evolved quite a bit over the last several years. And I kind of feel bad for people who just reference the list and then purchase based off this just a few years ago, because the list kind of, in my opinion, led people down the wrong path. I think since then, it's actually come a long way, and they've started to look at factors that actually lead to a more solid bottom line as opposed to more emotional factors or the most popular places to invest. And so I'm going to walk you through in this video how to read this list and how to read between the lines a little bit so that you can pick the absolute best place that's going to help you meet your goals in 2026. I'm Kirby Atwell, and since 2017, my wife and I have been investing in this very specific type of really high cash flowing short-term rental. And about 5 years ago, we got to a place of no longer needing to work our corporate jobs anymore and having enough income from our short-term rentals to support our lifestyle. And since then, we've taught literally hundreds of people how to do this through a very specific process, buying these very specific type of niche short-term rentals that a lot of people overlook. And so if you're interested in working with us on that process, you can go to the link that's in the description below. You can set up a call with me or my teammate, and we can talk through your goals and what you're looking to accomplish and the details of the program and see if it's a good fit for you. All right, so let's dive into AirDNA's report for the best places to invest in a short-term rental in 2026. And just so you know, there's a link to this report in the description below. So if you want to bring up a copy of it as we talk through it, you can just go there. So the three metrics that AirDNA uses to determine where is the best place to invest are demand, revenue, and investability. So if we just briefly look at what each of these mean, for demand, there's really two factors. So the trailing 12 months, so the last 12 months occupancy rate. So they're looking at, is it increasing? Are more and more people staying there or booking there? And then booked listing growth. So it tracks how many listings got booked at least once. And is that number growing? So that's the demand side of the equation. Then you look at the revenue, and this indicates whether properties in a market are becoming more profitable over time. So the big metric that they look at here is RevPAR. You'll probably hear that term thrown around. And that just means you're multiplying the average daily rate, that's, the average that you can charge for a short-term rental, multiplied by the average occupancy. And so these two always work in tandem. It's amazing how many times I'll see articles where they say occupancy's dropped way off in this market. And that only tells half the story, because what if the average daily rate went way up? Then your revenue stays the same. These always work in tandem or in conjunction with each other to really understand the revenue side of the equation, which is really important to understand. And then finally, investability. And this is a newer metric that they really haven't focused on as much as they should have, in my opinion, in the past. I think a lot of the markets that have been suggested, especially in reports a few years ago, were more emotional driven or popularity driven. And so investability evaluates the strength of current opportunities by focusing on properties that are actively for sale. So you'll see, if you go to AirDNA, you'll see that there's a market score. And so they kind of give the market a score of how good they think the market is. And it's a lot of different factors, and it doesn't necessarily take into account opportunities that are deals that are currently available for sale. So that's different from this. Now they're looking at investability. And the key metric that I think is the most important metric, and this is what I've been preaching for years and years as the first place to start, is this gross yield. That's what they call it here. And it's basically the RevPAR, your revenue divided by the cost of your property. It says we calculate gross yield, a key metric for investors, by dividing the property's annual revenue potential by its sale price. So you always, again, want to look at these things in conjunction, similar to on the revenue side, how you want to look at the average daily rate and the occupancy rate together. That dictates the revenue. The investability always needs to look at the purchase price compared to the overall revenue, because just because you're getting a great revenue, if you're paying an insane amount of money for that property, that's still not probably a good property. And vice versa, if you might not need to get an insane amount of income if you're buying a property super inexpensively and getting a great deal on it to still be extremely profitable on that property. So I would highly recommend starting with the gross yield as your first metric to determine whether a market's really investable or not. And it's the last metric that a lot of realtors in these more mainstream markets want to talk about. They'll talk about how beautiful the properties are, how high the daily rate is, how much your friends are going to love the property that you purchase, but they always want to avoid talking about the gross yield because it's just not that high in a lot of these mainstream, really high-end markets. And I'll talk about that in a little bit. This year, in 2026, it says what's new. This year, they've broken down by purchase budget. So how much you're planning to purchase a property for, which I think is great. So you can see in different categories so that you're not trying to compare multi-million-dollar average purchase price market to a market that's $150,000. You can still run gross yield on those markets and see what the average revenue is in each market, average occupancy, those types of things. But there are different types of markets, and you're going to have a very different type of traveler or type of guest. And so they talk through who those different types of guests are. So then a big question that comes up is, what about regulation? That's a huge question when it comes to short-term rentals because it's different everywhere. So in this report, they've basically eliminated markets that are so restrictive that it makes it really impossible to invest there. So it's basically like either it needs to be your primary residence to own a short-term rental there, or you have to be on site. Like that really makes it difficult to build a short-term rental business in those markets. And where you typically see those markets is in big cities, especially in the blue states where there's lots of regulation. That tends to be the areas where it's most restrictive. So they've just left out those as options here because it's just very difficult to invest. There's still a lot of other markets with regulations that vary quite a bit, but most of the time you can live within the regulation and just get the licensing that's required or pay the extra fees or taxes or whatever it is that they charge. And finally, that brings us to the best places to invest based on your budget. And so I'm going to walk you through, based on your specific budget and what you're looking to spend on a short-term rental, some things to think about for each of the top markets or budgets here. And so I want to start with the lowest two because, again, going back to gross yield, this is typically where you can find the highest return. And so if we start with $250,000 or less, a lot of people assume right off the bat that if it's $250,000 or less, even based off the stock pictures that they put here, that these are not very attractive homes, or they're going to be rough, or they can't be beautiful short-term rentals because they're in more affordable areas. And what I've found is that this just isn't the case. And so it says, what are things to think about in this market? So entry price is only the starting line. You got to look at total cost of ownership. Yield matters more than raw revenue, which I agree with. That means the overall income compared to what you're investing. Demand durability beats peak pricing, and then property type and guest fit matter more. So as we scroll down to the list, here's the list of the top 8 places to invest if you have a budget of $100,000 to $250,000. And the reason why I think gross yield is so important, and you can see here that the average yield for Finger Lakes, New York, which is the top one here, is 19.6. Then South Bend is 19.6. Rochester is 19.4. So they're all right around this 19% average yield, which again means the income potential, the average income potential compared to the average purchase price. And the reason why I think that's so important is because really I feel like we as short-term rental investors should not look at ourselves as real estate investors, but look at ourselves as allocators of capital, because we all have a very defined amount of capital to invest, right? Like nobody has unlimited capital. So how much income are you going to bring in, or return are you going to bring in per dollar invested? That's what this average yield is. And so if the average home price in Finger Lakes, New York is $184, but you can bring in $36,000 of revenue on average, then that's 19.6 average yield. And so a couple things to think about in this type of market is that oftentimes these are the least competitive markets. So when you get into the higher end markets, you're going to have way more short-term rentals because most people think of those higher end markets as more short-term rental areas, and that's where they need to invest. And then also you have opportunity to create even higher yield with multiple units in these markets. You know, if somebody's coming to, say, Rochester, New York, it's not uncommon to find multi-unit properties in Rochester, New York, and to expect to stay in a townhome or a condo or an apartment. And so the difference in nightly rate in a nice 2-bedroom apartment compared to a 2-bedroom house isn't really that much different. But a lot of times you can buy a 2-unit or a 3-unit at a price point that's pretty close to a single family home. So if you think about that, if the average purchase price in Rochester, New York is $182,000, maybe it costs you a little bit more for a 2-unit or a 3-unit. But if you can effectively almost double this, maybe it's not exactly double because maybe it'll be slightly less because it's a shared wall in between the 2 units, but say it goes from $35,000 to, I don't know, $60,000 instead of doubling at $70,000, but you got the property for $200,000, that's a huge bump in your average yield. And then you add another unit on that. If you buy a 3-unit, you can start to see how the net cash flow starts to increase dramatically. And so that's very doable in a lot of these more affordable markets, as opposed to the very high-end markets where somebody's only using it for a high-end vacation and you've got a big single family house. Yeah, typically they're not as likely to stay there if it's going to be a multi-unit type of setup. But people traveling to Rochester, New York, they travel there for all different reasons, for work, for funerals, for weddings, to visit family. And it's very common to stay in multi-unit properties. So it's not just high-end vacations that these people are using it for. So you have to think about who the ideal guest is as you're thinking about what type of market you want to invest in. The next one that I wanted to look at is the 250 to 400K range, because this is very similar. Like the average yield is slightly less in these markets because the price point's slightly higher, but these are still markets where you can still find a lot of opportunity when it comes to average yield. And also the other thing to point out is thinking about scale. If you're planning to build a short-term rental business over time and you're planning to build a portfolio, they're not all created equal. If we go back to the most affordable markets, if you look at like a South Bend compared to a Milwaukee, Wisconsin, I like both of these markets, but I like Milwaukee a lot more. And the reason is it's not just a one-trick pony. So South Bend, if you're buying there, everybody knows that's where Notre Dame is. And there's massive football games there. There's a big university. It's a big draw, but it's also kind of an isolated location in Indiana. It's not super close to a huge population center. In it of itself is a decent sized population, but it's not massive, not like Milwaukee, Wisconsin. So you don't get the spillover reasons that people travel that you would in Milwaukee. There's like millions of people, or at least over 1 million people. I don't know the exact amount, but it's a lot of people in the greater Milwaukee area. And so every possible reason you could think of that somebody would ever stay in a hotel that's ever traveling, between work, all just common travel reasons and also leisure, they're going to potentially book your short-term rental. So you're kind of just in the path of progress when you're near a larger city. And again, I don't recommend being in the city necessarily, but even if you're just on the outskirts where it's less restrictive, that can be a great place to be, as opposed to you're getting booked in South Bend because of big football games, because maybe some parents are coming to visit their kids at the university. Like, it's a much more limited scope of the reasons that people are traveling, and just less properties too. So the scalability in those two markets is very different. You're going to have a lot more opportunities, more diverse opportunities of different types of properties, and more reasons people travel. It's going to be a lot more stable when you're closer to a much larger population like Milwaukee, Wisconsin, as opposed to South Bend, Indiana. So the $250,000 to $400,000 range, I think these work very similarly. I'm a huge fan of these types of markets as well. And then as you get into the $700,000 to $1 million range, this is, I think, where most people start. This is where most people think of short-term rentals as working at these types of markets. They just envision it's got to be beachfront location, a high-end vacation area, and that's the only reason why guests are going to stay with you. And they overlook the fact that guests will stay for all different reasons. And so if you're just in an affordable area that's close to population, you're going to get lots of bookings. But these are going to be more of the destination type locations where people are on vacation, and that's the main reason that they're booking. And so if you think about the competition level, everyone in these markets is competing for that same traveler, only there because of a high-end vacation. Typically, it's not because they're just passing through and they're stopping for the night, or they're in town visiting family, or they're going to a funeral. Most people aren't going to book a high-end cabin in Pigeon Forge because they just are in town for a funeral, right? It's going to be a high-end vacation. And so everyone's competing over the same seasonality, and they're competing over the same type of guests, which is limited at some point. And so that's just something to think about. And then when you look at the average yield, yield on these types of markets, you can see it's just substantially lower. So if we look at places like Colorado Springs, Rocky Mountain National Park, Ventura, Oxford, California, the average income is around $65,000 for a $850,000 property. If you think about that, we invest in properties like I have a 2-unit that's a single family home and has an ADU in the backyard that we bought for $94,000, and we rehabbed the property. So we're all in for $200,000, and it made right around $75,000 last year. So think about the difference here. So instead of paying $850,000 for a property that brings in $67,000 a year of income, we have a $200,000 property that brought in $75,000 because it's 2 units. So each unit by itself didn't bring in that much, but it's 2 units. So we were able to bring in $75,000. So literally I could buy over 4 properties that I own that would bring in $300,000 of income a year and still be under the price of the average property, single family home in this market in Ventura, California. So when it comes to yield, it's not even like in the same ballpark as some of these more expensive areas. Now, the one thing that they do encourage you to think about in this report, and it's something I encourage you to look at as well, is the huge tax benefit that comes with owning short-term rentals. I've done a couple videos on that, and I break down how that tax benefit works. And that is something to think about, because if you're buying an $850,000 property, that's a huge write-off. That could be a couple $100,000 of write-off against your W-2 income in year 1. That's massive, right? And so people will get fixated, and it is something to take into account, but people will get fixated on that savings, on that tax savings, and they'll give up cash flow and yield. But you don't have to choose between buying a property that's a little bit more expensive and getting that tax benefit and not having any income, or buying something cheap and having the income. We could go back to these markets and pick one of these markets that's more affordable, and instead of buying a 1-unit or 2-unit, buy a 4-unit or a 5-unit or a 6-unit even, to where it's going to drive up that purchase price, but per unit, it's still very affordable. And so instead of buying an $850,000 average single family home in this market that makes $67,000, you can instead go to a market that, like Milwaukee, that the average price is $183,000, and instead buy a 5-unit or a 6-unit property, and your income will increase substantially. Say it's maybe $150,000 instead of $34,000 a year. That's very, very doable. But now the purchase price is higher because it's 6 units, and you've got that huge tax write-off, but also have going forward substantial cash flow. So these are just some of the things to think about as you read through this report. And I just want to scroll down to the top 10 places to invest. So these are overall the top 10 places to invest. And I want to share just some thoughts on this as well. So Port Arthur, Texas, Abilene, Texas, downtown St. Paul, Minnesota, Charleston, West Virginia, Springfield, Illinois, Lake Charles, Louisiana, Montgomery, Alabama, Akron, Ohio, Lebanon, Pennsylvania, and Jackson, Mississippi. Several people that I work with have purchased in several of these locations. So it's very confirming that these are some of the best places to invest, because I've been talking about these types of locations for years. And if you would have seen this list just, 3 years ago, it was full of all the most popular places to invest. And so AirDNA was telling you, the best places to invest are Hawaii, all the most popular beachfront locations, the mountainous locations that everybody thinks of when it comes to short-term rentals, that were all really expensive. And I have conversations daily with people who are stuck in properties that bought based off of those types of recommendations, and now they're just bleeding. They can't sell them because the prices have softened quite a bit. They're losing money every month. So they either sell it at a loss, or they just continue to bleed out negative cash flow. And that's not a good position to be in. So these markets are much more affordable, higher yield. You can see that yield right here. And I think long term, these are going to be, for the most part, much more stable places to invest, because there's just so many reasons why people will book these types of places. And they're super affordable for the vast majority of the population out there. And also the properties themselves are affordable for the population. So when you go to sell, there's most likely going to be a buyer, as opposed to some of these higher end markets where now people are struggling to even sell them because there's just not buyers. The one last thing to consider, though, as you look at this list, is just the long-term stability of the demand drivers. So I think some of these are places where they're doing things like building big data centers. And so maybe that demand will keep up once the data center is built. But in a lot of cases, it's a lot of construction jobs. And then it doesn't take a lot of human beings to run the data centers. They'll still have to maintain them and that sort of thing. But if there's a massive buildup of inventory during the construction phase, and then it's all built, and then it's just computer servers, you got to think about, is there going to be a big demand for short-term rentals long-term? So I think that's where some of this demand is that's leading to the suggestion of these are the best places to buy. And they might be in the short term, for sure, I think in the short term, but will they be in the long term? I think is yet to be determined. It's just something to think about as you consider what the best place to buy for you is. The one thing I've noticed when it comes to short-term rentals is that a lot of what leads to the highest income and the highest return on your investment is so counterintuitive to what feels like the best short-term rental investment. I see people all the time buying based off emotion and buying properties that will look awesome on their Instagram page and they can show them off to their friends. But if you compare that gross yield, it's not something they really want to talk about too much, because a lot of the times the sexiest properties aren't the ones that are actually going to put the most money in your pocket. And if you're looking to turn this into a long-term investment and build up a portfolio, I would suggest building up the highest gross yield, because that's what's going to get you to be able to walk away from your 9-to-5 at some point and live off the income from your short-term rentals. So again, I work with people through the entire step-by-step process of this, of buying the property, figuring out the perfect market for you, figuring out the right type of property, how to run all your numbers, the type of financing to use, how to set it all up and operate it going forward. It's all part of a step-by-step process. So if you're interested in that, you can set up a call with me or one of my teammates at the link in the description below, and we can talk through your goals and see if it's a good fit for you. Until then, thanks again for joining me for this video. God bless, and I'll see you in the next video.